John Burley here. Welcome to 2023. We are up at our cabin in Cholo, Arizona, and really excited to talk to you about what's coming up. We really think that 2023 is going to be the year for the small real estate investor. We have so many amazing things going on, but the first thing, let's talk about the current events, which has got everybody freaked out who doesn't know what they're doing. So all we're hearing about is high interest rates, markets, the prices are way too high, but they're coming down like crazy. We're talking about flawed models. I mean, think about this. A year and a half ago, everybody, their brother and their sister, and everybody they ever knew was doing flips and making $1 billion for eternity. It was never ever going to go down. It was always going to go up. Everything was going to be perfect forever. Okay, that's not how reality works. The reality is right now we have fewer real estate investors investing than we've had in years and years and years. Interest rate being high is not bad if you know what you're doing. It's actually a great thing. So let's talk about how we're going to deal with this, the recession, the economy, and everything else. Understand that literally all long-term great investors, and look, if you're a get-rich-quick guy or gal who wants to do nothing and get rich, I'm not your guy because I'm not going to tell you those lies and those stories, nor take your money. What I want to do is I want to share you how real investors work. Real investors understand how market cycles work. They understand that the contrarian position is the position of literally every great investor for the long term. Now, I'm not talking about the guys who make money for 3 or 4 years and then go under. That's not who we are, and that's not how you want to be either. So right now, taking the contrarian position, because the main emotion in the market is simply just stuffed and filled with fear. Fear. Everybody's freaking out. Take a deep breath with me. Okay, as a professional investor, bad is good, good is bad. The worst years that great investors have literally were 21s and early 22s and late 20s. Those are the bad times for professional investors because everything's going up and everybody's lining up. Remember, people were lining up for the privilege to pay the highest price ever paid for a piece of real estate in your town, and they all were bummed when they didn't get them. Now, everything's switched. Everything's flipped. You know, when we look at properties, let's just talk on market because that's the easiest. When we look at properties on MLS, which anybody can buy, right now, MLS, it's about thirds. 1/3 of the people are still delusional in February, March 2022, and they want to get $1 billion for their house. About 1/3 of them have gone like, hey, it isn't going to sell, it was worth $550,000 in February of 22, but the reality is I paid $250 for it in 2018 or 19, and wow, if I could get $350, $375, that would be a great profit, and a lot of people just need to move. And then there's 1/3 of the people who are so desperate for any offer, they'll take almost anything. They're sitting there, they're realtors, not very well trained, which would be the bulk of current realtors because so many came in during the boom when it was literally, list any property and multiple bids came in for above price. Well, those days are gone. Those days happen, but they're gone right now. They're not coming back for a lot of years. And so they're just sitting. And so we're seeing lots of people, seriously, just on MLS. You don't have to go deep off market to do this. They're doing 25, 35% discounts easy. And we're seeing some people, and many of my students are telling me they're picking properties off MLS for 40 to 60% what they're looking for. So there's a lot of things in the contrary position. I liked it best. There's about a gabillion things that are quoted as Warren Buffett that he supposedly said, which he didn't say most of them. But the one he really did say was, when others are greedy, be fearful, which kind of looked at where the high-end professionals like myself, I've been doing this for over 40 years. I come out of the world of Wall Street. I come out of private equity. We were very conservative with our positions that we're adding because we're long-term players primarily. In that late 19, then the 20 COVID, and when it went hyper in 21. And then the other part of it is when others are fearful, be greedy. In the good sense of the word. Because right now, when everybody's freaking out and scared and fear is running through the marketplace, this is when the opportunities are made. So the one thing I get all the time, we're going to cover this, and we're going to have a lot more conversations together, but I want to talk right now the 5 reasons, because there's 5 huge reasons why we are not even vaguely looking at 2008. And anybody who tells you they're looking at 2008, they're not a player. And they're not long-term, and they don't have a great success rate. I started investing in the late 70s, early 80s. I'm 62 now. And I formed my private equity company in 1989. We were literally the first company to come out of Wall Street roots and background to go out and form a private equity company to do single-family homes on a for-profit model only, meaning I only get paid if I make my clients money, which is what my students do. So the first thing is that let's talk about the big one. Everybody's like, oh, we're going to have a big crash. We're going to have a big crash. And they try and pull little pieces of charts to prove it. Here's the reality. The United States, we have charts that go back to 1765. And in the history of America, there have been 4 downturns. That's it. The first one, that happened in 1790. Well, we just had a big revolutionary war. Literally our first couple presidents were insolvent, living on the good graces of friends and family because so many of the people who had wealth in America dumped it in winning that war. So we had a big, big, big crash. The next big crash we had was 1872. 1790, 1872. That's 82 years. And, that was the end of the Civil War. So everybody, oh, well, they happen after wars. They happen after wars. That's what it is. But then the next one really wasn't 1929 from a charting point of view. It was 1932. So there went the whole war thing because World War I had been done in 18 and 2 was not even vaguely on the horizon for America. So much for its big wars that caused crashes. The next one was 2008. Here's the common denominator. They're 60 to 90 years back, and you can roll into the United Kingdom, and these things go back to 1100 on charts, and you actually have charts in ancient Rome where they're going back a couple thousand years before Jesus Christ. There's also Middle East charts that literally go back almost 6,000 years. And consistently, it's 60 to 90 years, and the reason is the people who had the money and lost it were dead, and their kids didn't remember. And now it's grandkids, great-grandkids, and everybody's forgotten, and markets never go down, we'll get rich quick. And that was 2008. Next thing, everybody's going like, wow, all this is happening. Look, Wall Street does 2 fundamental things that affect the real estate markets on a residential level. The first one they do is they are the main buyers and marketers of all the government guaranteed loans. And we can go conspiracy theories and down rabbit holes all day, but the reality is the FHA, VA, Freddie Mac, Ginnie Mae, Sallie Mae, all those alphabet soup loans, those are federally insured and they've never defaulted. If the United States ever defaulted on loans, the world literally is already on fire. They do that. They did that in the pre-2008 crash, and they did it before this downturn. But here's the difference. In that 2003, 4, 5, 6, Wall Street got very, very greedy because one of the things they do is part of the reason why they almost never go broke is because they don't invest their own money. They just invest others. They're basically a bookie. Wall Street got greedy. Excuse me. They got real greedy. And they bought this bad debt. And it was like there was people who knew better. I'm from there. So they took 4 bad loans and put them with 1 good loan and pretended it was all good. And obviously it all blew up. And that's why you had many Wall Street firms that went down and why there was such rampant losses because Wall Street themselves lost billions and billions and billions and into the trillions on that. This time, totally different. Wall Street got greedy again when they saw the markets going up. But Wall Street didn't buy bad debt. Wall Street bought the real estate. So they look, the number one holder of residential real estate is homeowners. There's almost 65% of all single-family homes are owned by the owners. Wall Street doesn't have more than mom and pop real estate investors, but obviously in the last decade, they've significantly raised their positions. Wall Street holds a large number of property. I'm not talking about the Zillows, where they lost $780 million on paper. And by the way, what if I told you Zillow had never been in the real estate business? They were trying to run their stock because if you look at their stock values, the stock went up billions and billions and billions of dollars on a $780 million loss. Sounds like a damn good rate of return to me. Wall Street holds a large number of properties that are long-term holds. And yeah, they may end up holding them a few more years than they want to, but they're holding these for the long, long term. When they do this, what this automatically does is it raises any bottom because they're not selling. They're not going to dump them if the market goes way down. So it's totally different. Wall Street didn't play like before. The next thing is the mom and pop real estate investors, and in this will include the smaller builders. In 2000 and, when you're looking at 2005, this would have been normal. They bought 5 houses in Las Vegas to grab one of those big boom bust cities. They bought 5 houses. They literally were in them for $10,000, all in, 10 grand. That's closing costs, down payments, everything. It was just basically, a liar loan, robo loans. They weren't looking at, they weren't qualifying, they weren't doing due diligence, they weren't requiring real down payments. And the houses, because interest rates were higher, everybody's like, oh my God, interest rates are 6, 7%. The interest rates then were about 8% for a good borrower. 7.5 to 8 for a good buyer. That's the platinum high-end buyers. So you're looking at PITI of like $1,400 a month on a house that only rented for $1,200. And because there had been such a massive overbuilding by the builders and the banks funding them, literally, you would have had 2 of your properties would have been vacant. So you're literally losing thousands of dollars every month, and you only have 10 grand in. It's a pretty big walk away. And back then, a lot of smaller investors and their accountants who didn't know what they're doing, they liked to pretend they weren't going to have to pay the debt back, which obviously most did later when they got 1099 a couple years after the fact, because it was debt relief, which is income. Today, you don't have homeowners that are in overextended without equity. If you look at today reality, even the people who overpaid, paid high prices in that 21 in particular era, they put down payments. If it was a government-insured loan, yeah, there was the 3% and the 5% programs. If they were bigger loans, people were putting 20% down. Investors, pretty much across the board, were putting 20, 25% down. They're coming in with hard cash. So the investor suddenly is like, wow, I'm into those 5 houses. I had to put $400,000 cash in. But the big difference is my PITI is $1,200 a month now because interest rates were lower. Even though your price was higher, the PITI, the debt service, is lower. That's why we always tell people, look, we don't look at the price and we don't look at the interest rate. We look at the return. That's what we're doing for a living. We're professional investors. We look at the return. We don't get emotional about interest rates being too high or too low. And we don't get emotional about prices being too high or too low. The numbers work or they don't. We'll cover that in a later YouTube here. So now they're renting it for $1,800 a month and they're paying $1,200. And unlike 2008, we're not overbuilt. We have a small supply that's too small. So the houses are all rented. So seriously, what does someone who put 10 grand down, who's losing $3,000 or $4,000 a month, have to do with someone who put $400,000 hard cash down, who's making $4,000 a month? Right, absolutely nothing. And for the homeowners, completely different. They don't have these toxic blow-up loans with adjustable payments and all that. That's a very small part of the market. And because the interest rates are low, even though they paid high, they're thinning on regular people $1,000, $1,200, $1,500 a month house payment. They can't rent their own home for what they have to pay. So we don't, although we have some, and that's what we're focusing on, we do not have this masses of people letting their home go. I just saw the latest numbers from December. I see some of these podcast guys, no offense, but reality. There is no tsunami of foreclosures or short sales. The federal numbers show that the default rate in December, 90 days, distressed loan, it's 2.7% of the loans on residential real estate are in distress. It's the lowest number in 40 frickin' years. There is no tsunami. That's just people trying to sell you crapola. It's not the truth. We don't have mass overbuilding. We don't have mom and dad investors in big trouble, and we don't have families in trouble. It's just not there. The prices went too high. Absolutely. But we're not in a 2008 scenario. Supply. The mid-2000s were glut of oversupply. I mean, our private equity company that we founded in 1989, we've invested in 11 states and 2 different countries, but we're focused in we're located, our corporate headquarters are in Phoenix, Arizona. And we literally, in 2008, officially, there was 225,000 doors with no family to live in them for any price. They had overbuilt that much. It was literally going to be 7 or 8 years just to fill in, which is when the Phoenix market started going again, 14, 15, 16. You just had to have people move to actually live in the homes. Today, we're the exact opposite. We're undersupplied. Even with sales slowing down, inventories are still at historically low levels if you look at the big picture and not just, oh, it's so different from 21. 21's not a perspective. It's not a reality. The next thing we got, and we talked about, the homeowners, they're not walking. So all this leads to is we don't have a big downturn. We don't have a tsunami of short sales and foreclosures. What we're looking at, if you look at charts and you look at history, and you've been doing this as long as I have, this is my 4th downturn in America, and I participated in 2 overseas. So I've done 6 of these. This is not my first radio, not even kind of. It's like a lot of people go, have you heard of so-and-so or so-and-so? And I nicely smile. I usually haven't, but I also let them know why, the context. If you haven't gone through a downturn and not just survived, thrived, then I'm not really interested in looking at your model or your content or your information and spending a bunch of time on a deep dive with it because you're too new. You don't know what you don't know. So right now, we've got hard money lenders dropping out like crazy. Wall Street's taking a deep breath. They're coming back, but they're stepping on the sidelines and waiting because they've been around. They're letting it go down. I'm not saying they're the best investors in the world. They're not. Private companies, private equity companies like mine, and what you can do, you can always outperform the big boys and girls. And it should be, because we can be far more selective. We're a lot more nimble. We're a lot quicker. And we're looking at the minutia, the small amount of deals. We're not looking at coming into a market and buying 100 or 500 or 1,000 houses every month for the next 5 years type thing. So we've got this tremendous opportunity out there. What we teach, and you can tune in again, is what we teach is the Burley model. And foundationally what this is real estate is extraordinarily easy if you have money, and it's hard if you don't. And that's just the truth. I know how to do, and I've done the no money down and the subject to and the owner financing. I've done almost 500 owner financing deals, but that's a small percentage of my career. Most of my deals, I did private placement. I bring on capital investors. I make a $10,000 placement fee. See, I come from Wall Street, not real estate. And in Wall Street, whenever we do anything, whenever we raise money for placement, we get paid first up front, $10,000 per door, per house. We then find the right deal, place the money, and invest in it for the long term. And we have investors who do loans and investors who just do it cash. But right now is one of the most amazing times you're going to see. And for most of you, this is the best window you've ever seen in real estate. So you need to get there and get doing it. We've got an event coming up in April. You can go to johnburley.com. So johnburley.com. You can also join me on Facebook at John Burley Real Estate Investing. And you can join me on Instagram at john.burley. We also have our YouTube channel. So I had a great time talking to you. I hope you learned a lot. I hope you're interested. We'll have a lot more content coming. Go to the website and check out what we're doing. This is John Burley saying thank you and God bless. Take care.